So compared to the people that don't look at it, you're essentially insider trading. You're trading with very valuable data that those people don't have. They have it, but they don't look at it, so they might as well not have it, right? So first of all, how did we do yesterday? How did the strategy that we looked at work out? How, when we were looking at the higher time frames and the lower time frames, it worked out pretty much exactly how we wanted to. We were looking at the price at the bottom of the range, right? So what happened was that we were chopping around at the bottom of the range. We had one more move to the upside, and then we had the big dump. Once again, the highest point of that range is right before the big move down, right? Because we're grabbing liquidity, or market makers are grabbing liquidity in order to do the move to the downside. So we were chopping around, and this is where many people get tricked, right? So there's this big move, and people will just start shorting here at the bottom of the range, and then they get stopped out right here, right? But the reason you do that, and the reason you chop around in this range, is so people put their stop losses here, so then we, like a market maker or someone that needs liquidity, can jump in and transfer that liquidity from their stop loss to their entry to then, do this move here. So when we look at the higher time frames, let's just go over the stochastics real quick. So this is what we were talking about yesterday, right? Our 30-minute was chopping around. Our 1 hour was up, going down. Our 2 hour was just about starting to go down. Here we go. And as we said, the 2 hour was at the top here, and we're like, it's probably going to go further down because the lower time frames are going to push it further down, which happened. And then the 3 hour was going to get pushed further down, which happened. 4 hour was going to get pushed further down from the 3 hour. 6 hour was going to get pushed further down from the 4 hour. 8 hour is going to get pushed further down from the 6 hour, and so on and so forth, right? And all of these turned around really nicely to the downside. Let's look at the daily. Even the daily had a pretty big move here, so that worked out well. Now when we looked at the lower time frames here, we were like, okay, well, the lower time frames might top out once again before we have a further move down. That's what I said. That's what my ideal entry would be, right? Not to enter here at the bottom of the range, but wait for the 15 and 30 to top back up, and when they top out, then we will have by default a much better entry into the trade, which would be just around here, right? So whenever we would layer our orders, we'd layer our orders to the upside, have many orders here which haven't been hit, but there would be orders to be hit right here, and we would have, even if we just entered right here, we'd hit it maybe a second time, so have a little bit of a better entry right here, and then just our bigger move, which we would catch on a 4 hour, 6 hour time frame, something like that. So when we look at the state right now, we just had a big move, right? So right now by default the stochastics are going to be a little bit messed up. I assume that the lower time frames are going to be bottomed out and might be stuck there. When we look at the higher time frames, so our 1 hour is reloading, our 2 hour is still on its way down, our 3 hour, let's see what it's doing, still on its way down, 4 hours still on its way down. So we're kind of in the middle of the move, right? So as long as our lower time frames top out, reload, and keep going down, then our higher time frames will just keep going down, where we could break this range. And as we break this range, then there's much more downside here. So here we go. So that's it. So when we trade this, right, let's just assume that we traded this trade, and let's assume that it went well. Now just assuming that we traded exactly what we said yesterday. The important part though is that whatever you're trading, or whatever trade you're actively doing, right? The result of that trade needs to be looked at with the correct mindset and perspective. What do I mean by that? What I mean by that is that one trade is just one trade, right? We always need to look at trading as a basket of trades. So when we look at this trade as a basket of trades, we'll be like, okay, well, what did we do in this trade that worked out well? Well, first of all, we're following our strategy, which was our stock strategy. We're aligned it across all our time frames. We connected the dots and got a pretty good bias of what's going on in that time frame. In the coin itself, right? And because we're looking at Bitcoin, we're looking at the overall market. And then on top of that, we're looking at other coins as well. And those coins already had this move. So we saw that Bitcoin was kind of trailing here, which would give us even more, or like an even bigger confirmation into the move. So what did we do? We looked at the confirmations. We looked at the stochastics. They were topped out. We were trading a range, so we had good entries in that range. We were anticipating that there will be some more choppiness going on before we top out once again, which was not all the way at the top of the range, was furthermore in the middle. And the more predictable the move is, the lower you will actually have your top, because if it's predictable, then there's going to be liquidity to enter short here, right? There's going to be sells here, which we don't want to hit. When you hit liquidity, or when you want to get liquidity, you need buy orders so you can sell into those buy orders. So we're looking at a basket of trades. So what we're taking out of here was what rules did we follow and what rules did we not follow. And as we do that, we compare it to the other trades that we have, to the other trades in a basket, which we can say is, say, 20 trades ongoing. Right, so as we have 20 trades ongoing, rolling on a rolling window, we can say that you will take, so take your last 20 trades, right? And if you've been trading before, I'm sure that you've traded 20 trades until now. So if you traded 20 trades, and if you haven't traded 20 trades yet, then just take all the trades that you've traded until now. So take 20 trades and analyze them. And while analyzing, you will see, okay, how was the performance of those trades? And we don't look at actually, was it profitable or not? Not yet. We look at what was the performance. Was it all over the place or was it consistent? If it was all over the place, then you're missing strategy. If it's consistent, then that's good. But if it wasn't profitable, then you're missing a profitability in the strategy, or the strategy is not profitable enough, right? But we're looking at a basket of trades. We're not looking at one specific trade. Because if we take one specific trade and we just say, okay, this was a good trade, let's go to the next one. And the takeaway from this trade was that, like a small difference in our strategy that we did, and then we just move on to the next one. Well, we're not building a feedback loop of our trades and of our strategy, right? If we just jump from one trade to the other trade without learning from the trade before, your result will be very, very volatile. Whereas when you have a strategy and then you trade according to that strategy, and then you look at every single trade and say, okay, did I follow the strategy, did I not follow the strategy, you will have much, much more consistent results. And then as long as the strategy that you're trading is good, which obviously should be the default, then you will have consistent results. The one very dangerous part is the fact that you can have a good strategy, but because you are between the market and your strategy, you're the person that needs to execute it, it can still get very, very messed up. So that's why we constantly talk about, first of all, the mindset, and second of all, understanding how the market works, because we need to be able to anticipate the market and be able to get good deals on every single trade. But how it's starting, the guys that were around for a while, you guys remember when we were back testing our strategies, right? So we took our strategy and then we were backtesting. So what we're doing now, essentially, is we're backtesting ourselves, right? So we're taking our last 20 trades, whatever strategy that was, and we look at them and we analyze them. We're like, okay, well, here I entered, here I exited, this was good, this was bad, why did I do that? And you will, right away, you will see, okay, I might, tend to not stick to my strategy. Or I do stick to the strategy, but the strategy has some, difficulties or deficiencies. Which, in this Discord, that should not be the case very often, because we have strategies that we can, that we're just using in the Discord that are good. Right? So, as we have them in the Discord and, they're good, that problem should mostly be solved. And the next thing is, do I apply the strategy correctly into the market? And do I apply the strategy correctly, consistently? So that is something important to do. What did we do in this trade? In this trade, we looked, number one was we looked at Bitcoin, and we looked at all the time frames that, a bunch of time frames, and based on those time frames, we connected the dots together and looked how each stochastic flows into the other one. If that's too many time frames for you, if you're just starting out, especially with a strategy, you can look at 3 or 4 time frames rather than 12 or however many we have here. And so that's step number one, right? Then we assumed, okay, on the higher time frames we have some alignment, so there's probably going to be a bigger move to the downside. On the lower time frames we have an alignment where we're kind of bottoming out, which means that we're probably top out the lower time frames, and after we top out the lower time frames, then we will have that big move. And this is essentially what I do with every single trade. I look at alignments at the higher time frames and at the lower time frames. Then I see how they work together, right? Either they're all aligned and we're all going together, or they're misaligned. So the lower time frames are aligned together and the higher time frames are aligned together, but they're opposite, which means that first the lower time frames need to top out or bottom out or really reload, and then we'll have a full alignment, and then we'll have a big move. Or they're just misaligned in general, where we don't see any alignment whatsoever, and if that's the case, then we just don't trade. So that's my strategy, right? Now I will take my past 20 trades, and I will see, okay, am I sticking to that strategy? Or, moreover, what is the performance? So that's the theory, right? What is the actual real performance that I've been trading in the live market? Now the thing is that people like to, and that's just normal human psychology, people like to lie to themselves how much they lost and how much they gained. They will pump up their wins and they will diminish their losses. But if you look at an actual P&L, and any exchange has that, an actual P&L on a day-to-day basis, how your account looks like, then you will see, based on the trades, you will see what the actual performance is. And people don't like to look at that, but trust me, if you look at it, you will learn so much about how you're trading. And those problems or the quote-unquote mistakes that you've been doing become so clear and so easily fixable. So by looking at your past 20 trades, you understand, is what I'm doing, is my theory actually right? If it is, great, how can I improve it? If it's not, great, how can I, change it so it works? And, you're in a good place because this is something that we've been doing a lot. So we're probably able to help you. And then, as you have been looking at your past 20 trades, now you do your next trade, right? So now you roll your basket of 20 trades up one trade. So the last trade, the first trade in that 20 trade window, with your trade that you did right now being the most recent trade, the oldest trade you just kick out. Right? So you kick out the oldest trade, you take the new trade, and you still have a basket of 20 trades. And you will just roll that basket of 20 trades every single trade that you're doing. And what will happen is that you will always see an overall, performance of your trading. And when you look at that, you're like, okay, did I go according to the rules? Did I go according to the strategy? Because remember, you are segmenting the strategy part and the execution part. Once you're actually trading, you're just following the strategy that you've been building before, right? So you're thinking creatively, you're back testing, you're testing and assuming before that, and once the strategy is built out, then you're executing on it. And then once you execute on it, once you trade a bunch of trades with it, then you take that data and you try to redo it as well. That's like same thing in business or in e-com or any product that you build, right? First you build the product based on the data that you already have, and then you market it, and then you get customer feedback, and then you'll go back into working on a product, right? Same thing here, except your product is the strategy, and you executing on the strategy is the marketing part, and the customer feedback is your trading performance. But the principle is the same, right? But the important part is that we don't look at just one trade, we'll look at our basket of trades, right? So we're looking at our trailing trading performance, meaning that we're not looking at, okay, this trade was good, this trade was bad. We're looking at, okay, my past 20 trades have improved compared to the past 20 trades before that. Why did they improve? And this, bigger thinking, it literally means that you're thinking bigger. And you understand the fact that, there's going to be more trades after your next trade. And there's going to be more trades after the trade after that. So it makes absolutely no sense to focusing only on the current trade. You're focusing on a basket of trades. Because think about it, when you were like right now, you're in right now, right? And I'm sure you had some good trading days, you had some bad trading days. But if you would focus your entire trading career, you would only focus on improving and being good enough to be the best you can be on January 3rd, so basically you're working for your future self, right? And if right now you would have been doing that in the past, then you would be benefiting from it right now, right? So and this is how you need to think. You need to put in the work so your future self, which isn't far in the future, it can literally be a week, right? But for many people that's too far in the future. But you're working at a larger basket of trades and you're looking at the trend of how you're trading. You're not looking at specific trades. And how do you see, or how do you notice if you think about trading the right way? Well, I see that often when someone texts me and they're like, they're very, very excited about one trade that they did, right? Like overly excited over the last trade that they did because it was a really, really good trade, which is great, and I'm happy. However, that means when you're overly excited over one trade, what that means by default is that you are focusing on one trade, right? If someone would come to me and be like, I just doubled my account over the past 20 trades. Well, now that's an accomplishment, right? Having a huge win on one trade means essentially nothing because I don't know your volatility. I don't know your past 20 trades. So the very next trade, you can blow your account. And what was the worth of that huge win? 0. It was nothing because you lost the money afterwards. So that actually has absolutely no value. It only has a value if you're able to sustain that over a longer period of time. Longer period of time, we can define it right now as 20 trades, which by the way is not that much. So, like if you trade every single day, if you trade like 4 or 5 times a day, then, that's 5 days of trading. but at least you have some form of statistical significance when you look at your performance. You don't look at one trade, you look at your past 20 trades. And if you don't have that right now, which I assume that you don't have a list of your past 20 trades, do that. Do that right now. Look at your past trades that you've been doing and write them down. And most likely than not, because you haven't been focusing on it, your trades will look, a little all over the place, and that's fine. But just by looking at it for the first time and realizing it, you already made a huge step, and you already put yourself above, a large majority of traders that are out there, because they don't look at it. So, but literally just by seeing a basket of your last 20 trades, writing down your last 20 trades, seeing the performance of it, ideally charting it on TradingView or somewhere, will bring you so far ahead, because you just looked at extra data that other people don't look at. Think about it that way, right? It's freely accessible, that data. Obviously, everyone can look at their trading performance and trading history, but people don't. So, compared to the people that don't look at it, you're essentially insider trading. You're trading with very valuable data that those people don't have. They have it, but they don't look at it, so they might as well not have it, right? So, they give you the opportunity to do legal insider trading by looking at data, super valuable data that they don't have. And that's what this is, right? So this is to drive the point home. This is by writing down your past 20 trades, looking at it and looking at your real, because that means that you're looking at your real performance of how you've been trading, and that is the closest thing that you have in order to estimate your future 20 trades or your future one trade, right? That when we were developing AIs for the machine learning models for some of our strategies in the hedge fund, what we were doing basically, let me just explain this to you real quick, like a little bit of story time. I think we have time for it. So we were backtesting the strategy, and it was working really well, like incredibly well. And we're developing it, but then after a couple weeks of developing it, we came up with a problem, which is a pretty big problem, which was that in the backtesting software that we developed specifically for the strategy, which we were rushing because we tried to finish it as quickly as possible because we had investors and so on and so forth. What happened was that in the data that the strategy was working with, there was we had an indicator that was either showing positive or negative, and that indicator was looking one single candle ahead on a 30-minute time frame. That's a strategy that's trading on like the 8 or 4 hour, so like on larger. But on the 30-minute time frame, it was looking one single candle ahead. And what happened was that the performance was really good. And once we removed that error, the strategy essentially broke. It wasn't working really well at all. And we're like, okay, well, how is it possible that such a small look ahead bias has such a big impact on that strategy? But it did. So then what we did, we looked at it, obviously, like that's how we solved most of our problems, right? We sat down and we looked at it in detail. And what happened was that the next candle was actually pretty predictable. Like us humans looking at it, we can more often say what sign, positive or negative, the next candle was going to be. So then what we did was we took all the data. So we took a lot of data, right? Essentially the past 20 trades, and we put it into the AI, and it had all the data from before. And all that it had to do is, so it had like thousands of candles before, and all it had to do was predict the sign plus or minus of the very next candle. That was the only thing it had to do, and it worked pretty well. And turned out that, you know, the bug that we had in the code, which was telling us the next candle, which, you know, in real life we wouldn't know, we actually got pretty close with like a 98% accuracy or 99% accuracy to guessing, building a machine learning model and training it, and then guessing what the next candle is going to be, and it got pretty accurate. And then the strategy was working, right? So we took, you know, a chunk of data, a basket of data from before, and we were just, and we used that to estimate the very next candle. And this is what we're doing too. We're taking the basket of trades, and because of the basket of trades, we're much more likely now to be able to estimate the next possible trade that we're doing. And the reason we want to estimate that, because we want that estimation to be positive, always, right? So when someone shows me one great trade that we did, that they did, like, congratulations, great. But if your past 20 trades are extremely volatile, all that means is that your next trade can be an absolute zero. It can blow up your account right away. And if that one doesn't, then the next one can, and then the next one can. And, you know, on an investor basis, which, you know, that kind of gives you a good indication if your strategy is good and if it's likely to make money, is how an investor put money in it or not, right? And if you're very volatile, no investor would. Maybe a gambler, but a gambler would also put money in a slot machine. It's the same thing, right? So that's not really viable. That's not really a viable, consistent way of how to get money out of the market, which is something that we're trying to do. That's the entire point of what we're trying to do here, right? So you need to decrease that volatility, and you need to be consistent. How can you be consistent over your past 20 trades? Well, you need to stick to the same set of rules. The set of rules needs to be a good set of rules, right? That's an important part. And, you know, it's not like, you know, we talk about it as something that's, you know, obvious and self-explanatory and easy to do. It's not, right? We're just in a good position. We're just in a privileged position because we have that work. That work has been done already, right? So we can reap the benefits from it by using those strategies. But, you know, in general, it's much harder said than done. But we have that. So the set of rules are there. So now we're like, okay, are we able to stick to the rules consistently enough so our performance is consistent enough? And, you know, in that goes, again, pillars of consistency: strategy, mindset, and risk management, right? So risk management, being able to, you know, getting the best deal on a trade, anticipating trades, all of that, it all goes into it. But, you know, we don't look at one trade. We can be happy about, okay, this trade went well, we anticipated the right way, we entered the right way, it was great, perfect, on to the next one. But we don't just look at this one trade. We look at, okay, so we're adding this trade into the past 20 trades that we had. How does this affect our past 20 trades? It affects it positively, great. You know, we're trading, you know, very similar trades all the time. That's great as well. On to the next one. And by having a, you know, trail of 20 trades, rather than just, you know, looking at the last one trade that you did, will completely change your mindset of how you should be thinking. Because just thinking about one trade is, it doesn't make any logical sense whatsoever. The only reason why us as humans we would do that is because we get that instant gratification from it if it was a good trade. Or, you know, we just focus on it if it was a bad trade, because that's the only thing that we can focus on. But neither great or horrible, whatever the trade was, that's not your performance. Your past 20 trades, that's your performance, and that's the difference, right? That's something very important to note, is that your performance is not the last trade, your performance is the last 20 trades. And that's something that we want to note. I'm just looking at the scalper here real quick while we're talking, because we got some signals. As always, it's doing its own thing. It's working well. We can look at what the bundles are doing here actually. Might have to log in. See the performance on those while it loads. But yeah, so by default, we want to look at the past 20 trades. If you don't have 20 trades right now, then or like you don't have it written down, which I would assume, that's absolutely fine. That's not a problem. Look at whatever data you have, whatever exchange you're using, look at your last 20 trades, write it down, and start tracking it from this point on, and you will see that your mindset will change pretty much immediately, right? So we don't want to focus on a single trade. We rather want to focus on our performance, which is a basket of trades, and the minimum basket of trades that we should look at is 20 trades, right? If you're trading more or more frequently or something like that, then you would look at more trades too than 20. But 20 is a good starting point for us, because it's 20 times more than what we usually do, right? So anytime you think about your trading performance, is the last 20 trades. And then when looking at the last 20 trades, we want to analyze them, right? So you want to look at their performance. Are they all over the place, or are they consistent? If they're all over the place, then you're lacking a strategy. If they're consistent, are you profitable? If you're profitable, great. How can you optimize it? If you're not profitable, you might need to think about improving the strategy, or improving your execution of that strategy, which is obviously something that we do a lot in the Discord anyways. Those are the important things. So while we look at single trades, or when we go over single trades, that's one thing, but that's not your trading performance, right? And what I would like to see is everyone keep a log of your last 20 trades and look at them before you trade. Because, if there's a bad trade, then there's a bad trade, and it's gonna sting your eye until you kick it out of the past 20 trades by trading more. But it's very, very important, even if it's painful to look at, it's very, very important to have that basket of past 20 trades, because that is your actual trading data, right? Even if you might not want to see it, you still need to, because that is directly affecting how you're going to trade now. So that is your best guess on how you're going to trade in the future. And what the main thing that we're looking at is, are you volatile or not? What does volatile mean? That means that the result of your trades vary a lot, which probably is going to be the case if you're just starting out, which is fine. But then we're trying to get that down, because let's assume that we have two traders. One trader, their account on average, or like most of the time, their account moves by 1%. Right? So it can either move 1% up, 1%, or 1% down. Most days it moves 1% up, right? So, they're compounding, they're doing great, and, it's just a constantly growing account. So let's just assume that, say, 80% of the time, right? 80% of their days are winning days. So 80% of the time, their account grows by 1%, and 20% of the time, their account drops by 1%. Completely fine, right? They can have a bad day, whatever. Out of 10 days, they have 2 losing days, so they lost 2% and they got 8%, right? Great. Now, same situation, same win rate, right? 80% win rate. However, the volatility of the second trader is not 1%, but 50%. So now, if they, day one they did great, day two they did great, day three they did great, and they're compounding, by the way, right? So day one they made 50%, day two they compounded that 50%, and so on and so forth. So by day four they're up like a couple 100%. However, day five, their losing day comes and they lose 50%. So out of the, say, 400% that they made, they just lost 50% of that. So they lost 200%. And then guess what? The next day is another losing day. So now they're, now they're below their starting point. And that's on a 50% volatility, which most people have more. But taking that volatility, and I'm sure that there are some calculators that will show you that on the internet. We should probably just do a calculator ourselves and put it on the website for you guys to test it out. But with a 50% volatility, you are guaranteed to blow your account sooner rather than later. And you guys can calculate it, or maybe Moonwalk, we can just put it up on the website. Let's say you have an 80% hit rate and your account volatility is 50%. So it either goes up 50% or down 50%. Most of the time it's going to go up, but sometimes it can go down. Your account will end up at zero within a few days because of that volatility. All you need is 2 or 3 losing days in a row, and you're done, right? If your volatility is 1%, you're chilling. There's nothing that can happen to your account, and you will constantly grow. So when someone looks at their last 20 trades and they have a very, very low volatility, that means for an investor, amazing. I can predict how much money this is going to be. This is going to make me. There is no chance of a huge drawdown. I can throw money at this, and I would love to throw money at this. However, if you get a very, very volatile trader, then we're like, okay, well, tomorrow I can end up with 400% of my money or zero. Well, if I'm an investor and I have that liquidity either from other people, or I have that liquidity because I sold my business after working on it for 10 years, I'm not going to risk that and, possibly lose all of it by tomorrow. I don't need to do that. So, and we should think about it the same way if we want to grow our accounts or if we want to get consistent results out of the market, right? Because that's what we are investing. We're just investing into ourselves if we're trading with our own money, or if you're doing a challenge and or you pass the challenge, then obviously you have a funded account and so on and so forth. But at that point, you're just trying to be consistent. You're not trying to grow the account. You're literally just trying to be consistent, right? So that is the important part, looking at the past 20 trades rather than just one trade. Because if a retail trader only looks at one trade, that's how, you make sure that your perspective stays as small as possible, which will make it so much easier for institutional traders to kick you out of every good trade because you just hyper focused on the small things. So a basket of trades, number one, and then looking at it, analyzing it, and making sure that you're following a strategy and that your volatility of that performance is as low as possible, right? You want to be as consistent as possible, because if you are, then you can actually predict how your performance is going to be. If you're all over the place, if you had a good trade, it does not matter. It does not matter, because you're so volatile that if you extend it over a set amount of time, then your account will just blow. We will do that. We'll put it on our website, like this calculator, where you can set your hit rate and your volatility, and based on that, you will be able to see the probability of blowing your account within X days. We'll do that. because I would like to see the exact number that we want to see the exact number. I would like to see the exact number of how long, like what to a say 90% probability or something like that. How long do I have to trade with the 50% volatility in order to blow my account? I think it's going to be pretty quick. And by the way, many people do that. So yeah, for example, not to throw anyone under the bus, but Saifa was literally doing that just when he came into the Discord. His goal was 50% a day. So literally you were doing that, and you did blow a couple accounts before we got to that consistency. So yeah, that's the main part I wanted to cover today. Trading wise, we're just probably gonna have some more downside depending on what the lower time frames are gonna do. And so anyone, if you post your past 20 trades, or at least the summary of your past 20 trades into the Discord, then I will look at it and I will give you an overall estimate of your volatility and probably what to improve and what to work on, because that's something that we've been looking at so many times, not just from traders but also just from strategies themselves, looking at the overall volatility. So yeah, and then you can do a bunch of other stuff. You can compare it to the market performance itself, see if you outperform the market and so on and so forth. But that's for the past. The main point is look at a basket of trades. Don't look at a single trade, and based on that, look at your performance. And from there, there will be so many epiphanies that you will have just by looking at it. You will, trust me, you will realize so many things. And I'm saying it the same way I used to say it with the backtesting for strategies. And the people that did that, right away they texted me and they were like, holy shit, you were right. I the amount that I saw in the strategy, I look at it completely differently now just because I went through the trades. Again, for reference, when we were building our strategies for the hedge fund, we could not get to the metrics we had to for our investors. And then one day we just sat down, we're like, okay, we just have to go through this. We went through every single trade that we backtested ever, which was hundreds of trades. But then we exactly understood how the strategy is working, and we exactly understood how to filter it out, how to optimize it. And that's how the bundles and the dashboards happened in the first place. So yeah, I have it on good authority that it's very, very good if you look at your past performance, live performance. And that's something that many people don't do. And what we will do in the Discord is we will start tracking that. And by tracking that and you being aware of it, you will trade completely differently. Because you don't have one trade in your head right now. You don't have an arbitrary number in your head right now. You have your live performance of your past 20 trades in your head. And you will make completely different decisions when you trade. So yeah. That's all I wanted to cover today. If you guys have any questions, as always, let me know. And if you don't, I hope this was somehow valuable for you guys. I would love to see some performance reports of the past 20 trades for you guys. Just post them in the general chat or in the charts chat, and I'll take a look at that. And other than that, if you're watching this on YouTube, make sure to check out the Discord. We have all the strategies. If you wonder what indicators I have here, or the scalper bot or whatever, it's all part of the Discord. And for people that do think that they're consistent, we have the funded challenges that are live right now. And if you pass that, then you'll be trading with 5 or 6 figures. In which case you obviously should be consistent, and you don't have to over risk or over leverage or do any of that stuff, but just, you know, have a predictable source of income. So yeah, that's all from my side. I think Stolz was writing something. Let me make sure that I don't close the call. Okay, there we go. Perfect. Thanks. I hope you enjoyed it. And yeah, other than that, I'll see you guys tomorrow on the call, and I'll see you in the Discord.